All right, let's move on to our companies here because we want to talk about Dick's Sporting Goods, and I've always liked this company. We never bought it, but I always liked it. Their symbol is DKS from the specialty retail industry. I was shocked to see that the short on the float side is 11.3%. That's above what we feel comfortable with. We do see that the PE ratio does look good, 13.1 versus 19.6. Price to sales 1.1 versus 0.6. Price to book value 4.6 versus 3.3. And your price to cash flow is 11.6 versus 8.3. And again, valuation ratios, you always want them lower than the industry average. And they have a nice PEG ratio of 0.8, which means you're not paying much for the future growth of that company. Their earnings were up 16.3%. That's about 60% higher than the industry at 10.3%. Sales only climbed by 2.1%. Industry did beat them at 2.8%. The analysts seem to love it. Their 5-year earnings per share growth estimate is 14.6%. The industry a negative 1.3%. They pay a decent dividend. It's a 2.6%, using 30% of their earnings to pay that out. We do see that, let's see, on the balance sheet here, you got a current ratio, good liquidity, 1.8 versus 1.7. The debt to equity, a little bit worse in here for me. It's 1.4 versus 1.3. That'd be the top of our range that we feel comfortable with. So they seem to have a lot of debt on the balance sheet. We also do see a net profit margin. That checks in at 8.7. That compares the industry at 3.4. That's a big positive. And free cash flow. They did about 500. I believe that's 500 million. I don't think it's billion. Which was below the industry at 1.3 billion.
I'm going to give the numbers here on Dick's Sporting Goods, and then we'll kind of get into the conversation around them buying Foot Locker, which
what a surprise!
Yeah, huge surprise. But current price for Dick's Sporting Goods is $184.02. The 52-week range, the low here is $166.37, and the high $254.60. So it's really pulled back. The last week, which includes the announcement of the Foot Locker buy, it's down about 15%. Market did not like that announcement. And then year to date, the stock is down actually about 20% still. Going forward, though, I mean, the valuations on this company, they look good. I go out to January 2027. I see estimated earnings per share of $15.24. I mean, it gives you a target sell price at $252.98. Trades under 12 times those future earnings. But the big issue here is the announcement of the Foot Locker deal. I think it was terrible. I don't know what they were thinking. And especially with that high debt level you brought up, I think this is just silly.
Was it a cash deal or a debt deal?
This is what's interesting.
A stock deal.
It's very interesting. So they announced they're going to buy Foot Locker for about $2.4 billion. Their stock fell about 15% on the day. Foot Locker went up 85% on the news. So they were the clear winners there. But under the agreement for Foot Locker, shareholders there can receive either $24 in cash, which is a roughly 66% premium to the average share price over the last 60 days, or they can receive 0.1168 shares of Dick's stock. I don't know why you would take the stock option here. I think I would take the cash hands down if I owned Foot Locker stock. And the interesting thing, though, is I bring up with Foot Locker is a huge premium on that day, right? As I said, it was up 85%, but the stock has been atrocious. Even with that deal, year to date, the stock for Foot Locker was up around 10%. Over the last 2 years, it's still down close to 40%, even with that 85% increase. 10 years, down 60%. Again, even with that 85% increase. I mean, the stock has been terrible. So I'm not sure what Dick's saw here, but I think this could be a big mistake, especially with that debt load.
And I think you said the offer was like $2.8 billion was the number?
2.4.
Okay, 2.4. Well, I just looked at the balance sheet real quick. Cash and equivalents, $1.7 billion. So that means...
Here's debt.
Yeah, if everybody... I don't see, again, why anybody would take the stock, I don't get it. But if everybody took the cash offer, they're going to have to raise their debt even more than what it is. I want to say, gee, I like Dick's Sporting Goods, but I don't like that debt level, and that would be enough to tell me, like, no, I think we're going to stay away from this company.
And the interesting thing here is the CEO came on because I was like, what are they going to do with it? And they're actually going to run the companies as two separate entities. Generally, when you do that, you're going to have accretion and you're going to run the companies the same, essentially. But the thing that I worry about is Foot Locker's international. It's also a totally different demographic than what Dick's Sporting Goods is used to. So now you're going to have to learn how to market to a different demographic. You're going to have to learn how to operate within a mall. You're going to have to learn how to operate internationally. I mean, it just didn't make sense to me. The only thing that is a positive here is they both have big kind of contracts essentially with Nike. Well, now Nike maybe is going to have to bend a little bit to Dick's since they're going to have a huge order book essentially.
Right.
That's the only thing I see as a positive. I think I would be a seller of Dick's at this level.